Dividend growth investing saved my life. Okay, that's probably a little dramatic, so let's try this instead. Dividend growth investing has improved my focus as an investor. It's helped me understand my investments better. DGI has given me confidence to worry a lot less about recent world events, the latest investing fads, and even the day-to-day ups and downs of the stock market. Choosing DGI as my main strategy about 10 years ago has eliminated the temptation to find the next big thing, and it has encouraged me to concentrate on the quality of my investments and the soundness of the businesses, as opposed to hoping I'll strike it rich. I expect the companies that my wife and I own to pay us big dividends the rest of our lives. And when I say big dividends, I mean that both literally and figuratively. Hi everybody, I'm Mike Nadell, here for the Dividends and Income channel. If you like our content, do me a favor, will you? Hit the thumbs up at the bottom of the video, subscribe to our channel, and ring the bell so you get notifications of new videos as we publish them. Today I'm going to talk a little bit about why I settled on DGI. So how did I get here? Well, for years, my wife and I simply contributed a percentage of our paychecks to our 401k plans, and we allocated the money toward index funds. We maxed out our Roth IRAs in similar fashion. Those plans let us accumulate and compound wealth without overthinking it. I imagine many of y'all have done something similar. Sometimes, however, I felt we came out okay despite some of my choices. For example, there was Black Monday, October 19th, 1987, when the market crashed 23% in one day. The next day, I sold the index fund in my 401k and put all current and future contributions into the plan's money market fund option. In other words, I panicked. Having bought high, I sold low. The exact opposite of what I should have done. It took me months to regain the courage to return to index funds. So our money sat on the sidelines, and we missed a good chunk of the recovery from that Black Monday crash. In the grand scheme of things, though, Black Monday barely registers as a blip in the market's history. In the late 1990s, low-cost online brokerages became all the rage. Every stock related to the internet and technology shot up. I decided that if everybody else could make big money investing in something.com, I could too. So I signed up for an E-Trade account and threw my money around. WorldCom, Nortel, Pets.com, Palm, JDS Uniphase, AOL, what could possibly go wrong? On one sketchy website I visited, an expert expressed his bullish feelings about companies by advising investors to lock and load. So I locked and loaded, buying a bunch of stuff I didn't understand. Even the proven companies I bought, like Microsoft and Walmart, were vastly overpriced. But that was okay, we were told, because the internet made everything better. Ignore earnings, ignore fundamentals, ignore valuations. This time it's different. Well, the infamous .com bust slapped me upside the head. I'd have been better off putting my money in a coffee can and burying it in the backyard. I returned to the more boring index funds. And again, I saw mostly positive results over time. After reading a few paragraphs in an investing magazine in June 2008, again, excellent research on my part, right? I bought shares of blue chip companies, 3M and Procter & Gamble. As it turns out, that's how I first stumbled onto dividend growth investing, even if that's not what the magazine I read called it. 7 months later, with the world in a full-blown, worldwide economic crisis, I was laid off from my job. Thankfully, this isn't some sad story about how I had to stand on a street corner begging for food. We had a solid investing base, we never got in the habit of spending money we didn't have, my wife had a recession-proof job as a registered nurse, and we had sold our house shortly before the crisis and had that money in cash. So we emerged from the Great Recession okay. We were way more fortunate than millions of others, I know that. But despite our relative good fortune, the recession did take a major bite out of our portfolio. I hated worrying about what horrible surprise the market might have in store for us next. I began thinking there had to be a better way, and I started looking for it. I first read about dividend growth investing in 2011. I liked the idea of it. Buy shares of solid companies that sell needed products or services. Companies that not only pay dividends to shareholders, but also raise those dividends year after year after year. And I noticed that while the prices went down for those two stocks I bought in 2008, 3M and Procter & Gamble, they kept raising their dividends, and each saw their prices recover pretty quickly too. After calculating how much money we'd need in retirement to supplement our expected Social Security and pension payments, I made a plan to ensure that the income stream would be there, even if the market were to crash several more times before we reach retirement. We began buying rock-solid name-brand dividend-growing companies like Johnson & Johnson, McDonald's, Microsoft, Home Depot, Lockheed Martin, Apple, Pepsi, NextEra Energy, WEC Energy, and Starbucks. There was a learning curve, and I made plenty of mistakes, But as time went on, I learned how to avoid most investing mistakes, and I gradually built our current DGI portfolio, the one that will let me and my wife retire without financial worries, the one that will pay us for life. Okay, let's go over some things I like about DGI. Here's 5 of them. Number 1, fewer worries. Yes, the stock market goes up over time, but history is filled with pullbacks, corrections, recessions, crashes, and other monsters that lurk in the shadows. There are wars and uprisings and political shenanigans, and yes, even global pandemics. But as long as dividend growth investors choose their companies wisely, we'll be rewarded with growing income streams even during recessionary times. For example, even as 3M's price plummeted during the Great Recession, its dividend actually grew. Number 2, quality shines through. Most companies that grow dividends for years and years are financially strong, with consistently increasing earnings and free cash flow. Number 3, compounding is cool. One of the great things about dividends is that they can be reinvested into more shares of the stock, a process known as dripping. And then those new shares will earn dividends, which then can be used to buy still more shares. For example, in December 2014, I bought 10 shares of the utility Southern Company for a public portfolio I manage on a website called Seeking Alpha. Here's how that position has grown through the end of 2020. So those 10 shares of Southern grew to become more than 13 shares, and it happened without putting another cent of outside money into the company. Albert Einstein called compound interest the 8th wonder of the world, and I'm sure he would have been equally impressed by the compounding effect of dividend growth investing. Number 4, lots to choose from. While boring, old-school companies such as 3M, Johnson & Johnson, and McDonald's have grown dividends for decades, many businesses we don't usually associate with income also have become reliable DGI names. For example, our portfolio includes Visa, Starbucks, Home Depot, Amgen, L3 Harris, Honeywell, and Automatic Data Processing. And number 5, progress you can see. I enjoy watching the dividends roll in and compound. I love seeing my income increase, quarter after quarter, year after year. Even when the market ticks down, my divvy dollars keep ticking up. If we needed any further proof, the pandemic has provided it. Yes, a few companies did cut or freeze their dividends, but the vast majority didn't. And our portfolio of proven dividend growers saw its income stream increase by almost 10%. It's satisfying, it's reassuring, it's comforting to have a reasonable degree of certainty that my stocks will pay me and my wife for the rest of our lives. There are plenty of other things to like about dividend growth investing, and I'll be discussing some of them in future videos. Again, please give us a thumbs up, subscribe to our channel, and ring that notification bell so you don't miss any of our new content. Take it easy, everybody. Back at you soon.